Are you thinking about paying points to buy down your mortgage rate? Well, you might want to rethink it. While it might sound like a smart move because you're ultimately getting a lower payment, it could actually cost you more in the long run. The question you always have to be asking yourself is, how long will it take me to recoup these costs? And if I'm being honest, the answer will shock you. Before we dive into whether paying points is a good idea, let's actually make sure we're on the same page when we're talking about what points actually are. Mortgage points, sometimes called discount points, are an upfront fee that you're paying your lender in order to reduce your interest rate. The way to think of it is you're essentially prepaying your interest costs in exchange for a lower monthly payment. How much does it cost? 1 point costs 1% of your loan amount. So for a $500,000 loan, 1 point would cost you $5,000. How much does it save? In most cases, 1 point will buy down your interest rate about 1/4%. Now the question you're probably asking, is it worth it? And I'm going to go out on a limb and say in most cases it doesn't. And that's because most people don't actually keep their loan long enough to recoup that cost, which basically means you're not saving enough to justify paying this fee to begin with. So with that said, I want to take some time here and talk about why you should not be paying points to buy down your mortgage rate unless you're the type of person that I'm going to talk about at the end of this video. Now, the topic of buying points can be used when you refinance. It can be used when you get your initial loan. But essentially the idea is the same, that I don't believe that you should be paying upfront money to buy down your mortgage rate, especially in this current environment. Because when you get a mortgage, whether you're refinancing or getting it for the first time, you are traditionally paying closing costs that are associated with that loan. And adding points on top of that makes it more expensive, which more or less means that you're tying up free cash that you could have in your bank into the property that's going to make that money inaccessible. You're not going to be able to access that money in the case that you have an emergency, or in some cases there might be a better investment out there that you could be putting that money into that would make you more money than you would potentially save by buying down that rate. So instead of tying up thousands of dollars in upfront costs, keeping that cash available could offer you more financial flexibility. So let's use an example here to break it down in real terms of what this actually looks like. Let's just say you have a $500,000 loan, and with today's interest rates, whether you're refinancing or getting that loan for the first time, they're giving you a rate of 7%. Well, that breaks down to a mortgage payment of principal and interest every single month of $3,326. Well, let's say, for example, that lender's saying, hey, you can buy down that rate and it'll save you 1/4%. So instead of getting 7%, you can get 6.75%. But in order to do that, it's going to cost you 1%. Well, in this case, that's $5,000. And in your head, that might seem like a good idea because you can actually lower your monthly mortgage payment because you're getting a lower rate. But let's translate that into real money. What does that actually look like? That $500,000 loan at a 6.75% interest rate gives you a mortgage payment of $3,242 a month. That's only $83 in savings. So my question to you is, would you rather have $5,000 in the bank or save $83 per month? And what I'll tell you in my experience is most people would rather have that $5,000 in the bank versus just saving $83. But let's take that a little step further. If we take that $83 in savings and we divide it into the $5,000 it cost us to get that savings, that's going to tell us that it's going to take at least 60 months in order to recoup that cost. And in my experience, most people don't keep their original loan for anywhere close to that period. And that's because interest rates fluctuate. Right now, we're close to the peak that we've seen in mortgage rates over the last couple of years. Yeah, mortgage rates have been higher than where they are right now, but they've also been a lot lower. So we're actually on the higher side of where mortgage rates have been traditionally, which means we actually have a higher likelihood of mortgage rates moving lower than we do higher. And the reason I bring this up is because there's a really good chance that you're going to continue to see lower mortgage rates over the next couple of years. So if that's the case, why would you buy the interest rate down to a rate today that you might be able to get for free in a couple of years? Now I know what you're saying, Jeb, refinancing is not free. At some point in the future, I'm going to have closing costs. I'm going to have different fees associated with that. So it's never going to be free. And the answer is yes. In some cases, you can get it free. In fact, I'm the perfect example. I actually refinanced 2 times within 1 year, taking my rate from 7% down to 6.5% with absolutely no closing costs. The lender paid my closing costs because I took a slightly higher interest rate than the best rate out there, which allowed the lender to give me a credit to cover all the expenses that were associated with that loan. And then because interest rates moved lower again within that year, I took my interest rate down from 6.5% down to 6% and was able to do the same thing again with no money out of pocket, while also not building it into my loan. My loan balance never increased during that period of time because I wasn't building the cost into my loan. So if you're somebody that is considering paying points, just understand your break-even point. If in some way you're able to buy down the rate and your recoupment period is a year or 18 months, then in some cases it might make sense to pay down points. But I'll tell you, in most cases, recoupment is going to be 3, 4, 5 years. So in most cases, it's not going to make sense because homeowners traditionally refinance every single time interest rates drop. So if you're somebody that's considering selling your property within the next couple of years, or you're somebody that's going to refinance if interest rates move down, then there's a high likelihood that you'll end up losing money versus saving it when buying down points. As most of you are aware, mortgage rates fluctuate every single day, and predicting their future is nearly impossible. So what if you're paying points today to see interest rates drop tomorrow or 2 or 3 months from now, where it makes sense for you to actually refinance? If you've paid this upfront cost, it's hard to justify taking advantage of that lower rate when it becomes available. Now understand, there might not be an opportunity for a lower mortgage rate in the future, but if I were a betting man, which I am, I do believe that there's a high likelihood that you're going to see lower mortgage rates in the future. But here's the thing, mortgage rates don't just travel down in a straight line. Some days they go up, some days they go down. And predicting where interest rates are going is very, very difficult to do. So what I'm recommending here is before you just jump on the bandwagon and say, I'm going to buy down my rate, make sure you're just looking at that break-even cost, looking at how much money it's going to cost you, and look at where mortgage rates are, and look at the likelihood of where they're likely to go. If we're in a super, super strong economy where everything is just pumping out, there's a chance that interest rates might stay higher for longer. But at the same time, if we're in a more of a weakening economy and things are slowing down, businesses are slowing down, that sort of environment, then there's a chance that lower rates are probably coming in the future. So you just have to look where you are in that cycle to see whether or not there might be an opportunity in the future. Now, if interest rates were back down at 2% and you told me you wanted to buy your interest rate down to 1.75, I tell you to go for it, right? Because there's a chance you may never see that rate again. But the fact we're sitting today somewhere around 7%, I think there's a very high likelihood that we see lower interest rates in the future. In fact, the prediction at the moment is interest rates will end 2025 somewhere around 6.33%. So instead of buying down your interest rate to 6.75% today, why wouldn't you just wait, keep that money in your pocket, and if interest rates move lower, then you're in a position to take advantage of it. Then you have that cash available to put into another investment, or maybe to buy down your rate in the future once interest rates already trend down to their new baseline. And that's something I want you to consider, is what else could you do with that cash that could be a better investment for the foreseeable future? Maybe it's just putting that money into an emergency fund in case something goes wrong. Or better yet, maybe you just use it to pay down the principal balance on your loan, to put that money directly towards your loan and pay down that balance. So if you get an opportunity to refinance, you're actually refinancing a lower loan amount. And that's actually going to take me into the trap that a lot of people do when they end up refinancing. A lot of people pay down their rate. They buy points. They have closing costs associated with their loan because they're trying to get the absolute lowest rate when refinancing. And the lender tells them, hey, you can refinance at no cost. There's no cost to you out of pocket to refinance. But what they're doing, instead of having a $500,000 balance like we used earlier, your balance becomes $510,000, or in some cases $515,000, because what they're doing is taking that cost associated with refinancing and just building it into your loan, basically using your equity against you. So you're never actually paying down that loan. And one of the other things that happens during that same process is a lot of lenders will reset your term. So let's say that you bought your house a couple of years ago and you've been paying down that balance for 3 years. Well, you actually have 3 years less on your 30-year mortgage. So essentially you only owe 27 years on that mortgage. Well, what will happen a lot of times when refinancing, that trap, if you will, is not only are those costs being added to your loan balance, but the lender is resetting your loan term from 27 years back to 30 years, which makes that savings look greater than it actually is because they're adding 3 years back to the term of your loan. So in reality, the savings aren't nearly as great because you're adding to your loan balance, you're adding to the loan term, which puts you further and further from your goal of actually paying off that mortgage. So instead of being the homeowner that pays points every single time they refinance or adds to their balance every single time, just make sure you're doing it strategically. Have your lender give you side-by-side comparisons of what it looks like not adding to your loan balance, not increasing the term of your loan versus maybe doing that. Maybe in some cases you don't ever plan on paying off that loan. You're going to sell that property. You're going to do something else. Well, have your lender give you a side-by-side comparison of what that looks like so that ultimately you can make the decision. What happens more often than not is that you're just told this is what you're going to do. And because you aren't a mortgage professional, you don't know the right questions to ask. You just get stuck in this hamster wheel of doing what you're told. And in some cases, you have good money chasing after bad ideas or bad intentions in some cases. So when you're going through that process, just make sure you're working with a professional. If you'd like to work with our team, we help a lot of people here on YouTube. You can get in touch with us using that link in the description of the video. But with that, I want to take the counter arguments and the rebuttal that a lot of people have when talking about paying points in buying down their interest rate with the idea that buying down those points actually lower your mortgage rate. Yeah, they do lower your mortgage rate, but it costs money to do it. It's not free. But let's say, for example, you're working with a new builder, right? You're buying a new construction home and they're giving you money to buy down your interest rate. In that case, it might make sense to buy down that rate, unless you can use it somewhere else, right? If you can use it to pay down your closing costs and, there's money left over and you can buy down the rate, fantastic, because the money might be lost otherwise. In that case, it's a good time to use it. And also, if you're in a position where maybe your job status is going to change, maybe you're retiring, this is going to be your last opportunity to ever refinance or take advantage of an interest rate again, then in that case, it also might make sense to buy down the interest rate if you don't have an opportunity in the future. But it goes back to the idea that you're keeping that loan long enough to recoup that cost. So if you're not one of those people that's going to refinance or sell in the near future, then it could make sense to do it. But otherwise, if you do plan on selling or you do plan on taking advantage of lower rates as they become available, then in my opinion, paying down points is a wasted expense. So with that, I want to leave you with some practical advice. Just do the math up front. Make sure you calculate the break-even point before you commit to paying any points. Also, consider your future plans. Are you going to take advantage of lower rates if they become available? Are you planning on selling in the near future? And then lastly, explore no point options, right? Have your lender give you a side-by-side comparison of what it looks like so that you can see on paper and ultimately make your own decision. Paying points sounds like a good money-saving strategy, but for most homeowners, it's just an expensive gamble. So before you commit, ask yourself, am I really going to keep this loan long enough to break even? Let me know in the comments, have you ever paid points when getting a loan or doing a refinance? Did it pay off or did you ultimately regret it? Let me know in the comments below. But lastly, if you found any value in this video at all, do me a favor, give me a thumbs up and consider subscribing to the channel.